This is the Ruby Tuesdays risk assessment. We are the JIT accounting firm, and this is our engagement team for the Ruby Tuesdays audit. I'm Chris Sherry.
I'm Sam Thompson.
I'm Winston Smith.
And I'm Brett Lyons.
In recent trends, Ruby Tuesdays has experienced declining sales and not reached their earnings benchmarks. We've also overall experienced a decline in business growth. There have been many store closings, some due to expiration of lease arrangements, and some due to poor operating efficiency. This is mainly due to rising costs of goods sold, mainly from higher food costs, but also the rise in real estate prices following the recent recession may increase the upcoming leases and rent. Also, finding and hiring a talented and capable workforce in a competitive environment could have a major effect on continued operations. The business is also dependent on economic conditions in the areas that they are operating in. The business environment that Ruby Tuesdays finds itself in is highly competitive, and it's only going to become more competitive in the future. Some of the major competitors of Ruby Tuesdays are Darden, which owns Olive Garden and Longhorns, Dine Equity, which is over Applebee's, and Brinker International, which owns Chili's and Maggiano's. The main products of Ruby Tuesdays are food, alcohol, and non-alcoholic beverages.
For materiality, even though usually we would base materiality on EBIT, because Ruby Tuesdays this past year had negative earnings, we decided to base it on total assets. And so we did materiality on 0.5% of total assets, and total assets were about $956 million. And so materiality is going to be around $4.8 million. And for the flux analysis, for the income statement, their revenues decreased by around $83 million. Their gross profit decreased by around $49 million. Their net income decreased by about $25 million. And then for their balance sheet, their inventory decreased by about $9.7 million. Their PP&E decreased by around $65 million. Their total assets went down by around $87 million. And then their accounts payable went up by about $8.7 million. And for the analyst estimates, the analysts estimated that Ruby Tuesdays would have a earnings growth of about 233% compared to the industry, which is at around 93%, which on one hand is good if you're regarding the going concern of the company, but on the other hand, it also puts more pressure on management to meet those expectations, which increases the risk of fraud. And however, this past year in Q4, they actually missed their earnings projections.
When evaluating the internal controls of Ruby Tuesdays, we looked at the incentives of top management and other controls within the company. Top management is heavily incentivized to meet their earnings. They're incentivized by stock prices, or stock options, sorry. Their chief executive officer has 250,000 options with a strike price of $7.81 if actual stock price exceeds $14 a share for Ruby Tuesdays. And their chief financial officer has 60,000 options with strike price of $9.34 if actual stock price exceeds $14 a share. They also have performance bonuses related to turning Ruby Tuesdays around and increasing profits and earnings for the company. The CEO has a 100% of his base salary he will get in performance bonuses if they are able to turn Ruby Tuesdays around. And their CFO has a 60% base salary, and if they hit earnings before interest, tax, and depreciation of $93,110,000, and if their average guest count at each of their stores grows by about 18.5 customers per week.
And all this adds additional motivation for the management to commit fraud.
And other things that we need to look at for internal controls is their CFO was replaced in June 2014, which means we need to do additional work regarding his work and making sure that it's up to the standards that we need. Ensure the same level of integrity and quality is present as the previous CFO, and also do the background check on him and other members of management. Their Ruby Tuesdays is also heavily reliant on key management for decision making, especially with implementation to the new rebranding of the company. They lack some segregation of duties in top management, which increases the risk of material misstatement. It increases opportunities for fraud and misstatement due to lack of checks and balances at top management, which increases the chance that the financial statements might be misstated, which is our biggest concern. Due to all these factors, we set the control risk at medium, just due to their incentivized management, heavy reliance on key personnel, and their heavily reliant on competent employees within the organization. We set inherent risk at high due to declining sales of the company, their failure to meet their earnings benchmark, a highly competitive industry, and factors outside of their control, such as fluctuation of food prices and their heavily reliance on economic conditions in which they operate their business. And due to all these factors, we must lower our detection risk, so we'll do more substantive testing, and we'll base it more around the year end rather than interim testing.
Alright, so for specific accounts to focus on, revenue is going to be a very important one. And some things to look at in terms of that is, since they use coupons, we want to make sure they are properly accounting for coupons and thus not overstating their revenue. And then we also want to make sure that the revenue actually exists, so they're not overstating it. Another big important account is going to be inventory. And some main concerns regarding that is actually the perishability. So food is very perishable, so we want to make sure that perished items are not on their books. Make sure that that's properly accounted for. And then we also found that they currently hold less lobster on hand. That they used to be a strategic strategy in order to lower the price of lobster. So now we need to actually evaluate and make sure that that's their main reason for inventory being down as low as it is, as they stated. Another big important item is PP&E. So they had to actually impair a lot of their property, plant, and equipment due to impairment. 41 out of their 64 stores had negative cash flows and thus had to impair down to salvage value. And also 33 restaurants had to close, and 11 of those were due to an expiration of lease. So overall, we want to make sure that PP&E is not overstated, and this is actually going to be one of the more difficult accounts for us to actually get correct and have proper assurance over. And then as far as risks, we've got, right now they're currently rebranding, so this is actually going to, if they do not rebrand successfully, then this is going to affect future financial statements. So we need to make sure that the proper disclosures are in place in order to properly inform investors of this risk. And then this is also going to increase management's incentives to meet these expectations and thus have a material misstatement on the financial statements. Another risk is availability of inventory, and this is going to be a lot due to seasonality primarily. However, also suppliers might have a shortage, so if for some reason something happens on a farm where vegetables are or where meat is supplied from, we need to make sure that it's properly disclosed in the financial statements that inventory availability is a risk. And also, certain applicable labor laws could pose future litigation problems. So, for instance, they already had a litigation due to employees working off the clock. So we need to make sure that their compliance with these laws are in place, and also know that make sure investors are aware that this is a risk moving forward. Also, the implementation of the new healthcare law. This is going to potentially raise costs, and it's going to be pretty difficult to measure for financial statement purposes. And then also the loyalty programs are going to have coupons, and we need to make sure that that's generating the appropriate demand that they actually are estimating that it's going to.